3, 10 or more times the leverage off every dollar you spend are soaring. And the number of leverage ETFs just hit a new record high. Adam Kobeissi is the founder and editor-in-chief of the Kobeissi Letter, always putting out really interesting data that kind of makes you think. And this, Adam, made me think I should be nervous because leverage ETFs by themselves, I got no issue with it. But when there's 700 of them, 200 created in the last couple of months, it feels like a semi-gold rush and not in a good way. What am I missing?
So I think, it's an interesting craze that's happening. If you look back to 2020, there was around 200 levered ETFs. Now you're at a record 700. But I think it's also even just beyond levered ETFs. There's just an ETF craze in general. There's over 4,500 actively listed or ETFs listed right now on the market. That's a record high, up 800 this year alone, year to date. But I think the leverage side of things is really a reflection of, and particularly retail investors are looking for as much exposure to a lot of these risky assets like stocks, the AI revolution, to the record run that we've seen since the April lows, or one of the best 5-6 month runs in history. But the question is, these products are a little bit more sophisticated than they appear on the surface. And if is retail positioned, or do they understand the risks of investing in these products?
So explain a little bit about the risks, okay? And I'm going to be super, super generic here because all these products, some of them may be different. I'm not going to be exact. You get my point, Adam. You bet $100 to win 100. That's called investing, right? Buy a stock, it goes to zero. That's investing. Well, if you buy a $100 stock and you can get 200 off it, 2-to-1 leverage, 300 off it, 3-to-1 leverage. But if it goes down, you're hurt the other way. So how does this all work? And how do they have enough stock to manage all these leverage ETFs?
Exactly. So the dangerous part about the ETFs becomes when you're applying multiples of leverage. So it used to be a few years ago 2 to 3 times was crazy, and now you're seeing ETFs proposed with 5 times leverage. And this could be even on a single stock. Like, for example, one of the proposed ones is on Nvidia. So if Nvidia fell 10%, you would lose 50%. This exposes you to ETF decay risk, which is pretty high in these products. And even in April 2020, I'm sure you remember when oil prices turned negative for the first time ever. Yeah. The triple levered ETFs were actually delisted. They literally went to zero. They should have gone negative, but it basically broke the ETF, and there was a big pushback. Now it's starting to return. I don't necessarily think this is something that can derail the market long term. I think it's more of a product of just how strong risk appetite and momentum is, and I think it's rightfully so. It should be strong,
but it's going. I think, Adam, I'm sorry to jump in. I want to get this in. Doing this for almost 30 years, I do believe that this will exacerbate any downside moves. If markets turn down, this is going to make them turn down faster and more aggressively. Not a bad thing necessarily.
Correct.
But people need to be aware of those risks.
Right. And that's exactly what I was getting to. So I think my long-term thesis is still bullish, but I think over the short term, this will drive more volatility. And we already saw it. I mean, take a look at what happened on October 10th when Trump tweeted about the China tariffs. Leverage, even beyond equities, look at crypto. We saw the biggest single day liquidation in history, $20 billion, 1.6 million traders were liquidated in under 24 hours. That was almost 10 times the previous record. So I think what the product here is, as you said, when we have violent swings, and the market is incredibly reactive now because basically any tweet or any headline at any given minute can move trillions of dollars of market cap. I think these ETFs will only exacerbate these moves, as you said. And as an investor, you have to position accordingly, because I don't see these products really going away anytime soon based on the trajectory that they're on right now.